If you ever want to watch intelligent people fool themselves, give them the same $50,000 and two respectable choices. One man takes that money and buys a rental house. The other puts the money into index funds. Both men feel rational. Both men can defend themselves. Both men can point to people who got rich doing exactly what they chose, and both men are in danger of lying to themselves. I have watched this argument for decades. Real estate people will tell you property is the royal road to wealth because tenants pay down your debt. The bank gives you leverage and inflation lifts hard assets. Stock market people will tell you that low-cost index funds win because compounding works while you sleep. Liquidity protects your freedom. And there are no midnight phone calls about leaking pipes. The trouble is that most people comparing these two paths are not comparing the same thing. The property man counts the rent check and forgets the hours. The stock market man counts the average return and forgets the years when his stomach turns to water. One man forgets to count the labor. The other forgets to count the emotional cost of doing nothing while prices swing all over the place. Then both of them announce conclusions as if the math were obvious. It is not obvious, but it is measurable. So let me show you the real scoreboard. Let us begin with two men at the same starting line. Jake has $50,000 saved. Marcus has the same $50,000. They earn the same income, live in the same city, and start at the same age. Jake uses his money as a 20% down payment on a $250,000 rental house. He borrows the other $200,000 on a 30-year mortgage at 7%. His principal and interest payment comes in at about $1,330 a month. He finds a tenant who will pay $1,800 a month. Marcus does something nobody wants to brag about at dinner. He takes his same $50,000, drops it into a broad stock market index fund, then sets up a plain automatic contribution of $300 a month. No leverage, no property tour, no contractor, no tenant, no story. On day one, Jake feels richer. That matters more than most people admit. He can drive by the property and point at it. He can tell friends he owns a rental. He can talk about equity, tax write-offs, and passive income. Marcus has none of that theater. Marcus has a statement. It is hard to impress anyone with a statement. Nobody leans in when you say you bought an index fund. Nobody asks to see pictures of your brokerage account. That is the first mechanism. And I want you to understand it because it quietly bends a lot of decisions. I call it visible wealth versus invisible wealth. Visible wealth flatters your ego early. Invisible wealth flatters your future late. A rental property gives you identity right away. A stock portfolio gives you mathematics right away, but it does not give you much social proof. And because human beings are social creatures, many of them choose the thing that feels like progress over the thing that compounds like progress. Jake is not foolish for liking the property. He is responding to something very old in human nature. We like what we can see. We trust what we can touch. We feel safer with walls than with symbols on a screen. But feeling safer and being richer are not the same thing. Now we come to the second mechanism. I call it borrowed size. Jake used $50,000 to control a $250,000 asset. Marcus used $50,000 to control $50,000 of assets. That difference is not small. It is the whole seduction of real estate. If Jake's property rises by 4% in a year, the house gains $10,000 in value relative to the $50,000 he put down. That sounds like a 20% move before he even thinks about rent. That is why leverage makes ordinary appreciation feel extraordinary. A modest asset move produces a dramatic return on your cash. This is the great romance of real estate. Small money can sit in front of big value, and I do not want to insult that advantage. It is real. It has built fortunes. It is one of the few socially acceptable ways an ordinary person can use a bank's balance sheet to accelerate his own. But leverage does not care whether the asset is moving in your favor or against you. Leverage is a rented amplifier. It magnifies gains. Yes, it also magnifies mistakes, concentration, and bad timing. People love to say, "My tenant is paying my mortgage." That sentence is true in the same way it is true to say that a restaurant is paying its rent. It sounds effortless until you remember there is a business attached to the sentence. The rent check is not profit, it is gross revenue. That brings me to the third mechanism. This is the one that destroys most back-of-the-napkin real estate math. I call it the gross-to-net collapse. Jake sees $1,800 of rent and subtracts a $1,330 mortgage payment. He thinks he has $470 a month in profit. 12 months of that looks like $5,640. 3 years of that starts to look like genius. Then the real world submits its invoices, property taxes, insurance, maintenance, vacancy, turnover costs, appliances, plumbing, roof work, legal risk, advertising, cleaning, travel time, mental bandwidth, capital expenditures that do not arrive monthly and therefore do not show up in the fantasy spreadsheet the way they show up in life. Over Jake's first 3 years, the property produces about $64,800 in collected rent. The mortgage payments total roughly $47,880. At first glance, the spread looks wonderful. Then the bill for reality arrives. Property taxes chew up about $3,000 a year. Insurance takes another $1,500 a year. A water heater fails and costs $1,200. A roof leak becomes a $2,800 repair. One tenant leaves and the house sits empty for a month, which means $1,800 of rent never arrives, and another $600 goes into cleaning and relisting. Suddenly that beautiful spread collapses. After all real costs, Jake's actual net cash flow over those first 3 years is not some heroic figure. It is probably somewhere around $2,000 to $4,000. That is still positive. I am not mocking it. But it is a long way from the story he told himself when he first saw $470 a month on paper, and I have not charged a single dollar for his time. That is where the fourth mechanism enters. I call it labor hidden inside the asset. Many people say they want passive income when what they really buy is unpaid management work. If Jake hires a property manager, he gives away 8 to 10% of the rent right off the top, on $1,900 a month. That is another meaningful slice gone. If he does not hire one, then he becomes the manager. He takes the calls, he screens the applicants, he arranges the plumber, he sends the reminder, he negotiates the renewal, he worries about whether that small leak is actually small. In other words, he either pays with cash or pays with attention. There is no moral difference between those two. They are both costs. This is where real estate owners begin to divide into two camps. The first camp wants to own property as an investment. The second camp wants to own property as an operating business. The first camp is usually disappointed because the numbers only work well when you accept the reality of the second camp. Real estate can be excellent. Casual real estate is often mediocre. Marcus, meanwhile, has a different problem. His problem is not that the asset asks too much from him. His problem is that the asset gives him too little drama. He checks his account once in a while. In year one, maybe it rises from $50,000 to roughly $55,000 in year two. Maybe it moves into the low 60s. He adds his $300 each month, but the account still does not feel important. It does not feel productive because nothing in the visible world has changed. No tenant, no address, no keys, no renovation, just digits. This is where many people quit the stock market too early. The first 5 years of disciplined compounding are psychologically underwhelming. The machine is working, but it is not yet loud enough for your emotions to hear it. That is why I call the fifth mechanism silent acceleration. Compounding does not seduce you the way leverage does. Leverage makes noise on day one. Compounding whispers for years. Then one day it is the only voice in the room. By year 3, Marcus has invested the original $50,000 plus $10,800 in monthly contributions. At roughly a 10% average annual return, his portfolio sits around $76,000. There were no emergencies, no turnover costs, no weekend trips, no negotiation. The asset did not ask him for labor, it asked him for patience. At this point, many observers would still say Jake is ahead because the property feels larger. And on certain dimensions, he is ahead. If his house appreciated from $250,000 into the $270,000 to $280,000 range by year 3, and the loan balance dropped a little, his equity may land somewhere around $55,000 to $65,000. That is real. That is not imaginary. Leverage gave him a large asset, and time has been quietly pushing some value toward him. So let me be completely fair, real estate. Its biggest advantage is not the rent. The rent is useful. The biggest advantage is the combination of leverage plus forced equity plus inflation riding on a larger base than your original cash. That is very hard to beat if you buy well and manage well. But if does most of the work in that sentence. Now move the clock to year 5. Jake has had more experience, which is helpful, and more reality, which is expensive. He has rotated through several tenants. He has replaced a roof for about $8,500. He has handled plumbing repairs. He has seen taxes and insurance rise as the property rose in value. He has probably lifted rent from $1,800 to something closer to $1,950. Let's put as much as beginners think. Many of the expenses rise with time too. At this stage, Jake may tell friends his property is cash flowing. He is probably telling the truth. The better question is how much and against what burden. His real cash-on-cash return after true expenses may hover in the 3 to 5% range. That is not disgraceful. It is not magical either. It is the return of a real business with friction. Marcus is still being underestimated by everyone except arithmetic. His portfolio keeps compounding on itself. Gains now start earning gains. Contributions still matter, but they matter less than before because the asset base is growing. Somewhere around year 7, depending on return sequence, he may be staring at a portfolio in the neighborhood of $135,000 to $150,000. He did not create a second job. He created a machine. People miss this because they compare rent checks to portfolio statements, and that is the wrong comparison. The right comparison is operational intensity versus mathematical intensity. Jake S. result is helped by his involvement. Marcus S. result is helped by his absence. By year 10, the comparison becomes truly interesting because the emotional lead real estate enjoyed in the early years starts running into the brutal honesty of elapsed time. Jake S. property, if it appreciated at a reasonable pace, may now sit somewhere between $335,000 and $350,000. His mortgage balance is down to roughly $166,000. That leaves equity of about $170,000 to $184,000. That sounds tremendous. And in one sense, it is. He took $50,000 and built 6 figures of equity. But here is the part many people skip over because it is less flattering in conversation. Over those 10 years, he also had carrying costs, repair cycles, vacancy, tax paperwork, and the constant possibility of tenant trouble. Depending on how honestly he records everything, his additional out-of-pocket spending beyond the original down payment may be another $20,000 to $35,000 over the decade. Marcus, after 10 years of the same boring behavior, lands somewhere around $165,000 to $180,000 with his $300 monthly contributions and average market returns, around 10%. His total contributions over those 10 years are $86,000, including the initial $50,000. The rest is pure compounding. Look at that carefully. At year 10, the two men are in roughly the same neighborhood. That is one of the most important truths in this whole discussion. Real estate is not automatically crushing stocks by year 10. Stocks are not automatically humiliating real estate by year 10. They are often much closer than the culture around each asset class would have. You believe the difference is in the route. Jake got there with concentration, leverage, paperwork, labor, illiquidity, and maintenance risk. Marcus got there with diversification, liquidity, automation, and the discipline not to interrupt the process. This is where I want to pause and say something that a lot of investors learn too late. Wealth is never only about the size of the outcome. It is also about the quality of the path. A path that leaves you exhausted, distracted, and one bad tenant away from disgust is a different kind of return than a path that leaves your calendar free and your attention unclaimed. You should count both. Now move to year 20 because time is the final judge in every argument about compounding. Jake S. property might be worth somewhere between $450,000 and $500,000, depending on market and location. His mortgage is close to gone or gone. His equity may now live between $400,000 and $500,000. Along the way, he has collected rent for 2 decades. But he has also endured 2 decades of ownership friction. Roofs, furnaces, turnover, repainting, legal compliance, rising taxes, rising insurance, occasional dead time, possible renovation, possible eviction, likely stress. After all of that, his net profit from cash flow beyond his true cost might be $40,000 to $80,000. In a very strong market, it can be better. In a mediocre market, it can be worse. The point is that the rent did not arrive clean. It had to fight through reality before it became his Marcus, with the same broad market index fund and the same $300 monthly contribution. Sees his original $50,000 grow into roughly $420,000 to $460,000 over 20 years at about a 10% annualized return. Total contributions over that span are around $122,000. The remaining hundreds of thousands are compounding. Nothing more glamorous than that. Put the two men side by side now. On net worth, they are in the same ballpark. That sentence makes a lot of real estate evangelists uncomfortable and a lot of stock market evangelists overconfident. It should do neither. It should make both of them more precise, because once you see that the outcomes can land in the same neighborhood, the real question changes. The question is no longer which asset class wins. The question becomes, which game are you actually built to play well? That is the identity flip most people need. The real asset is not the house or the fund. The real asset is the operator. A disciplined, patient index fund investor with strong savings habits can get rich in quiet fashion. A sloppy landlord with poor reserves can turn a good property into a long irritation. A smart, process-driven real estate operator can beat stocks in a very meaningful way. A panicky stock investor can turn the greatest compounding machine in the world into a disappointment simply by selling at the wrong time. The winner is often not the asset. The winner is the temperament fitted to the asset. Now let me be fair to the stock market critics, because they are not wrong about everything. Stocks do come with genuine weaknesses. The first is volatility. It is not theoretical. In 2008, the broad market fell roughly 37%. In early 2020, it fell about 34% in a matter of weeks. If Marcus had $150,000 and saw it become $95,000 on paper, that is not a minor emotional test. Most people say they can handle volatility until volatility asks them to prove it. The second weakness is that index funds do not send you an exciting monthly check. Yes, dividends exist, but on a total market fund you may only be looking at something like a 1.5 to 2% yield. That is not retirement magic. It is not replacing labor income for most ordinary investors. So anyone selling broad index funds as an immediate cash flow answer is selling fantasy. The third weakness is the absence of leverage. Marcus S. $50,000 controlled $50,000. Jake S. $50,000 controlled $250,000. That difference matters. It is why real estate has created so many fortunes for people who bought correctly and survived long enough. The fourth weakness is the lack of tax tools that feel as tangible as real estate S. A property owner may use depreciation. A larger operator may use a 1031 exchange to defer gains by rolling into another property. Those are meaningful advantages. They are not imaginary. Now let me be fair to the real estate critics too. Real estate has strengths that index fund investors dismiss because they are lazy thinkers. The first is that a well-bought property in a good rent-to-price market can create a beautiful combination of debt paydown appreciation, tax shelter, and inflation protection. If monthly rent is strong relative to purchase price, if expenses are honestly modeled, and if financing is sensible, property can beat stocks. The second is that real estate lets you shape the asset. You can improve operations, you can raise rents through better management, you can add units, reduce waste, improve tenant quality, refinance, exchange, or redevelop. In stocks, you are a passive beneficiary. In real estate, you can be an active optimizer. The third is house hacking. If you live in one unit and rent the others, you can reduce your own housing cost, build equity, and use leverage in a way the stock market cannot mimic. That is a genuine edge. The fourth is tax treatment. Depreciation can make taxable income look much smaller than economic income that matters. Good tax law does not make a bad asset good, but it can make a good asset far better. So I am not here to tell you real estate is a trap. It is not. I am here to tell you that romantic real estate is a trap. Spreadsheet theater is a trap. Pretending gross rent is equivalent to spendable return is a trap. I am also not here to tell you stocks are easy. They are not. Emotional passivity is hard. Watching other people boast about their properties while your account quietly compounds can make you feel like nothing is happening. Then a bear market comes and you discover whether you were really an investor or only a tourist. That is why the right comparison must include everything. You must include dollars, yes, but also time, also concentration, also liquidity, also stress, also optionality, also what happens if life gets messy, also what happens if you need cash in a hurry, also what happens if your zip code stagnates, also what happens if your tenants do not behave like spreadsheet assumptions. If you ignore those things, you are not doing math. You are doing branding. Now let me tell you what I would do if I were advising an ordinary person starting from this exact position. If you have no special advantage in real estate, no unusual knowledge of neighborhoods, no appetite for managing people and property, no reserves beyond the down payment, and no desire to build an operating business. I would rather see you in broad low-cost index funds with ruthless consistency. Why? Because the average person does not lose in real estate because real estate is bad. The average person loses because he buys a job while telling himself he bought an investment. The average person also loses in the stock market for a parallel reason. He does not lose because broad index funds are bad. He loses because he cannot leave a good machine alone. He panics, tinkers, reaches for leverage, chases hot sectors, or interrupts, compounding with fear. So here is the blueprint I would hand each man. If you choose real estate, do not buy a property because it makes you feel grown up. Buy it only if the numbers survive honesty. Demand a strong rent-to-price ratio. Build a repair reserve before you need one. Assume vacancy will happen because it will. Budget for management even if you plan to self-manage. Treat every capital expense as certain, not optional. Buy in a place you understand, not a place you can merely imagine appreciating. If you choose stocks, do not buy them as if they are lottery tickets. Buy a broad fund. Automate contributions. Refuse margin debt, unless you enjoy begging the market for mercy. Assume crashes are part of the admission price. Do not ask the portfolio to entertain you. Ask it to compound. Let boredom become your ally. And if you are unusually capable, unusually disciplined, and unusually capitalized, then yes, there is a third answer. You can do both. You can let the market compound in the background while selected property gives you leverage and tax shelter. But that is not where most people should begin. Most people should begin by becoming good at one game before pretending they can master two. That is the part nobody likes to hear, because what people usually want is not a clear answer. They want permission for the answer they already prefer. What they should want is a complete answer. So the next time someone tells you real estate always wins or stocks always win, ask one question. Did you include everything? Did you include the hours, the vacancies, the roof, the concentration, the sleeplessness, the liquidity, the tax treatment, the leverage, the behavior, the emotional cost of crashes, the cost of illiquidity, the power of monthly contributions, the drag of human error, and the value of freedom? Because the answer that includes everything is the only answer worth trusting. Most people are not choosing between a house and a fund. They are choosing between two lifestyles disguised as investments. One lifestyle says, I want to use debt management and tangible control to build wealth. The other says, I want to use patience, diversification, and compounding to build wealth. Both can work. Both can fail. The deciding factor is not what sounds richer at a dinner party. It is which structure still works when you stop flattering yourself and start counting honestly. And if you ask me for the cleanest single sentence I can give you, here it is. Real estate can make you rich faster if you buy right, manage well, and survive your own optimism. Stocks can make you rich more quietly if you save consistently, stay invested, and survive your own fear. The wrong choice is not property. The wrong choice is not index funds. The wrong choice is entering either one with incomplete math and borrowed conviction. That is how people lose money while sounding intelligent. And that is a very expensive habit.